Why were structural adjustment programs introduced during the Latin American debt crisis? Imagine a region struggling to keep its economy afloat, with countries unable to pay back loans they borrowed during easier times. That's what happened in Latin America during the early 1980s. Countries like Mexico, Argentina, and Brazil had borrowed huge amounts of money in the 1970s. They thought economic growth would continue and they could easily pay back their debts. But then global interest rates shot up sharply, especially in 1981, making borrowing more expensive. At the same time, prices for exports like oil, coffee, and minerals fell, reducing income from trade. Mexico announced it could no longer pay its debts in 1982, which triggered a financial crisis across the region. Banks stopped lending money, and many countries faced a liquidity crunch, meaning they didn't have enough cash to meet their immediate needs. To avoid a total collapse of their economies and prevent widespread defaults, these countries needed help to restructure their debts. International institutions like the International Monetary Fund and the World Bank stepped in with a plan. They introduced what are called structural adjustment programs, or SAPs. These programs were conditions for new loans and aid. The goal was to get these countries back on track by fixing their economies from the inside out. The programs required countries to cut government spending to reduce budget deficits. They also pushed for opening up trade by devaluing currencies, making exports cheaper and more competitive abroad. Deregulating markets was another key step, encouraging private investment and reducing government control. Countries also reformed their financial sectors, making them more efficient and less dependent on state control. These reforms aimed to stabilize inflation, improve the balance of payments, and restore confidence among international lenders. Countries like Mexico, Argentina, and Brazil adopted these policies to regain access to international capital markets and to restructure their debts. But these reforms came with social costs. Cutting government spending often meant fewer public services, higher unemployment, and increased poverty. Many businesses closed, and inequality grew as the rich got richer and the poor faced harsher conditions. So, while the main reason for introducing structural adjustment programs was to help countries pay their debts and stabilize their economies, they also led to tough social challenges. These programs marked a turning point in Latin America's economic history, shaping how the region developed in the following decades.